Time now for our three-stock lunch, where we hit three different stories and why they matter to you. Today, we've got three CEOs who were on CNBC earlier today. Here with our trades is Strategy Asset Managers CEO Tom Hulick. Up first, Goldman Sachs CEO David Solomon, not sounding the alarm bells on the markets.
Markets tend to overreact in the short term. We've all been through, stress. In markets, they overreact, but you get to a different place when you look forward 6, 12, 18 months. You get to a different place where the market has digested that change in the macro environment. It will be no different here.
So, Tom, how should investors react to Goldman Sachs?
Well, this is how we approach our thinking. For the overall markets to regain strength, you want to see the financials to participate, and Goldman is very, very strong financially. We prefer JP Morgan, but, they had strong trading revenues, and their investment banking is having challenges, but who wouldn't in this environment? So if you look at Goldman's earnings, they reported $4.74 billion in net income. Their earnings per share were very solid, but the headwinds from the tariffs and the global M&A softness are caution for us. So we see an opportunity in Goldman, but we prefer JP Morgan right now.
All right, Goldman up 3% today. Let's move on to Chevron with the CEO also on Squawk earlier, explaining what oil prices in the low 60s could mean for their capital spending.
We can't really swing our capital spending based on the price of today. It has to be based on our view of price out into the future. And our fundamental views on longer-term supply, demand, technology, policy are really unchanged. And so our longer-term view of prices are what drive our capital spending.
So on Chevron, Tom, what do? You a buyer?
We are. So we own Chevron. They're positioned to benefit from the U.S. policy support for offshore development. In any uncertain environment, dividend-paying stocks are the way to go, and Chevron offers stability and cash flow for our clients. And as a forward-thinking manager, we just don't like to ride trends, but there's a strategic viewpoint of this. I mean, right now, if you look at Chevron's yield, 5%, 38 years of consecutive increases, this is exactly the type of shareholder discipline we prioritize. And Chevron's a really good company to own in the long term with the exposure across the oil, natural gas, chemicals, refining and renewable space. This is a diversification that smooths out revenue cycles for us.
Last trade today, home builder Pulte Group shares popping after posting a beat on earnings and revenue in its first earnings report this morning. In its earnings report, I should say, not its first. Here's CEO Ryan Marshall on what he's seeing from the consumer.
As we moved into April, we saw a little more volatility and choppiness, and I think it's to be understood that the consumer was dealing with a lot, whether it was stock market volatility or concerns around the interest rate or fears about tariff-induced inflation. There was a lot for the consumer to deal with. We saw a lot of consumers continue to move forward. There were some that have elected to take a pause.
Tom, can you buy home builders, even Pulte?
We don't own Pulte. This is a very well-run company, but we've got to have greater conviction out there in the mortgage affordability area, and we need interest rates to come down. And housing demand remains structurally strong right now. If you come out to California, where we're from, there's not enough homes for people. Pulte reported very, very strong earnings, but we believe the stock's too dependent on declining interest rates, and we want to see that for further upside.
Zoom out for a moment. The Dow's now up around 935 points, the S&P 2.25 plus, the NASDAQ 2.5. This is after a rough day yesterday. How should investors use discipline and navigate these markets?
We continue to favor kind of a mix of high-quality dividend stocks, and so investors should just be patient right now. We need to see more clarity on the trade tariff talks. We want to see interest rates come down. We can manage through this uncertainty with discipline and optimism, and I'm very hopeful that we're going to have a very strong year-end.
All right. Tom Hulick, thank you. Also, remember, you can recap every three-stock lunch anytime you want. Got to scan that QR code on the screen, though. It's there right now. Or you can head over to CNBC.com for more also, I guess.